Normally, you can see a market crash coming,
Yeah.
like a storm rolling in.
Right.
You watch the clouds gather, the barometric pressure drops, and you actually have time to close the windows. But over the last 24 hours, any expectation of market continuity for you or anyone else has just been completely obliterated.
Oh, absolutely. It was an instant structural failure.
Yeah. In a matter of hours, a 19-minute primetime executive address didn't just cause a dip, it triggered this massive automated demolition of the crypto markets. I mean, over $420 million vanished in leveraged positions.
Just gone.
Brent crude spiked past $112 a barrel. And we saw this massive geographic split in how corporate treasuries are actually managing digital assets. So welcome to the deep dive.
Our mission today is really to deconstruct this violent reversal because the transient optimism we saw earlier this week, that's been mathematically dismantled by an uncontainable geopolitical escalation.
Yeah.
What you're witnessing right now is basically every institutional risk model being forced into a complete real-time recalibration.
Exactly. And we're going to break down the exact microstructural telemetry of this 6% intraday collapse.
Yeah.
We need to analyze why the digital gold narrative completely failed under current macroeconomic pressure.
Which is fascinating in itself.
Right. And we'll look at a strict 48-hour legislative window that could permanently redefine United States regulation of this entire space. So let's start with the order book carnage.
Let's do it.
We need to do a sort of what's new versus what we knew comparison to really understand the last 24 hours.
Okay, so looking at what we knew entering this window, the secondary order books were, well, they were heavily skewed toward the bid side.
Meaning buyers.
Right, the buyers. Algorithmic momentum engines and tactical participants had aggressively deployed upside leverage. They successfully pushed the spot price to an intraday peak, oscillating right around $69,300.
And that upward momentum was based entirely on unverified diplomatic rhetoric, right? I mean, the market was essentially breathing a sigh of relief over rumors of an imminent U.S.-Iran ceasefire.
Exactly. The algorithms were aggressively pricing in de-escalation. But here's what's new. That fragile optimism just evaporated the second the U.S. executive branch broadcast that 19-minute primetime address.
It was intense.
The president explicitly threatened to bomb Iran, quote, back to the Stone Ages to target all electric generating plants, and he completely abdicated the U.S. role in securing the Strait of Hormuz.
Basically telling dependent nations to grab it and cherish it themselves.
Yeah.
It's like these tactical traders built a glass house on top of a geopolitical fault line. And the second the seismic shift of that speech hit, the algorithm didn't just walk away. They systematically detonated the foundation.
That's a great way to put it.
Let's talk about how that actually works behind the scenes, because human traders didn't even have time to react to this.
No, they didn't. The impact was immediate and violent, really because of how modern markets are plumbed. Automated market makers, the algorithms that provide that safety net of standing bid and ask orders, they instantly recognized that the geopolitical reality had shifted. So they deliberately pulled their passive bid side liquidity.
Imagine you're trying to sell a house, and suddenly every single buyer in the entire neighborhood revokes their offer at the exact same second.
Yes. Without that safety net to absorb the selling pressure, the spot price plunged 6% to a trough between $66,000 and $66,381.
So this wasn't just a normal dip, it was a complete algorithmic purge.
Exactly.
Between $386 million and $422 million was wiped out across major exchanges. Over 140,000 individual retail trading accounts were completely liquidated.
And the imbalance in who got wiped out tells a very clear story here. Of that $422 million wipeout, the long positions, the people betting on the upside, accounted for $249 million.
Wow.
That's nearly 60% of the total destruction.
Which just proves the market was entirely misaligned. People were heavily over-leveraged on the upside and just completely ignoring the actual geopolitical risk staring them right in the face.
And the destruction wasn't limited to the primary asset either. Ethereum absorbed a massive hit. It basically functioned as a high beta risk vector.
Right.
So while Bitcoin dumped, Ethereum tumbled nearly 5%, dropping down to the $2,028 level.
The actual trading data on that is just wild. Over $1 billion in Ethereum sell volume flooded the derivatives market within a single hour of that executive address.
In 1 hour.
Yeah. And nearly $1 billion of that $968 million, to be exact, was concentrated entirely on Binance. That is total capitulation.
It really is. But to understand why a geopolitical escalation triggered a massive crypto sell-off instead of a flight to a safe haven, we have to look at the macro anchor.
Right, the oil.
Exactly.
Yeah.
The answer comes down to the global energy matrix. When a major conflict threatens the Middle East, the global energy supply gets choked off.
So the executive address, plus the guaranteed continued blockade of the Strait of Hormuz, caused Brent crude to violently surge 5% to 6%. It breached $112 per barrel.
And that hits consumer logistics immediately.
Yeah, U.S. regular gasoline jumped nearly 5 cents in a single day to $4.06 per gallon.
Right, and this $112 oil parameter is the thermodynamic reality that invalidates the Federal Reserve's disinflationary projections.
Because it mathematically guarantees persistent upstream inflation. Every manufacturer, every shipping company, they all have to raise prices to cover the fuel.
Exactly, which forces the central bank to abandon rate cuts and maintain a restrictive, higher-for-longer monetary policy.
Okay, wait, hold on a second. I have to challenge this.
Sure.
Wasn't the entire foundational thesis of Bitcoin that it acts as a sovereign hedge? Like, exactly when fiat systems and traditional logistics are breaking down?
That's the narrative, yes.
So why are institutional allocators treating it like a, volatile tech stock right now?
Because the fiduciary narrative collapses when it collides with an elevated risk-free rate. Because interest rates will remain high, institutional allocators are aggressively stripping zero-yield exposure from their portfolios.
Okay.
As a result, the 30-day rolling correlation between Bitcoin and the S&P 500 has spiked to 0.75.
It's just the highest it's been in months.
Right. And you see this exact reaction in the ETFs. This completely snapped the previous month's ETF recovery. On April 1st, the U.S. spot ETF complex saw an immediate net outflow of $173.73 million.
Wow. So institutions really are treating it as a high beta technology proxy to be dumped during a macro panic. Not as digital gold.
Not right now, no. And the institutional panic isn't just about inflation models. It's about the verifiable physical reality of the conflict actively expanding.
Yeah, the kinetic escalation. Iran immediately retaliated following the U.S. address.
They did.
The Bahrain Defense Forces intercepted drones and missiles, and one drone actually struck a corporate building.
Which fulfills an IRGC threat against U.S.-linked tech companies.
Exactly. But the civilian impact is what really escalates things.
Yeah.
The Israel Defense Forces confirmed Iranian ballistic missiles targeted the Tel Aviv metro area, utilizing wide-area cluster munitions.
Terrible.
Yeah, impacting civilian sectors like Bnei Brak and Petah Tikva, severely wounding at least 14 civilians, including children. And the death toll overall is now over 1,900 in Iran, 19 in Israel, and 13 U.S. service members.
The human cost is staggering. And compounding all of this is the fracture of NATO. The U.S. president actively threatened to withdraw from NATO, calling the 75-year-old alliance a paper tiger.
Which forced NATO chief Mark Rutte to schedule an emergency visit. And it prompted U.S. senators to invoke a 2023 law that requires a two-thirds Senate majority to even allow a presidential withdrawal.
This creates an entirely new layer of macro implication.
Let me point out the absolute paradox here for you, the listener. If Europe cannot rely on U.S. Article 5 guarantees, they have to execute unprecedented deficit spending to build domestic defense bases, right?
Absolutely. Trillions of euros.
Right, which guarantees severe long-term fiscal deficits and massive fiat debasement across the Eurozone.
Yeah.
And yet the immediate market reaction to the exact scenario digital scarcity was built for is a massive liquidation cascade.
It's the disconnect between short-term liquidity needs and long-term realities. But there's a profound, permanent paradigm shift happening quietly under the surface.
The corporate Treasury divergence.
Exactly. While retail traders get liquidated and Western ETFs see outflows, we're seeing a complete geographic divergence in how corporate treasuries actually accumulate this asset.
It's like two totally different playbooks.
Right. So we're seeing Western capitulation. Debt-burdened Western proxies are failing. Genius Group, which trades on the NYSE, just announced they liquidated their final 84 BTC.
Just to pay off $8.5 million in fiat debt.
Right. They were hamstrung by a U.S. court injunction blocking them from raising funds, so they completely abandoned their Bitcoin-first strategy.
Which proves that accumulating volatile assets using toxic debt in a high-interest environment is a fatal structural flaw.
Completely fatal. But across the Pacific, it's the exact opposite. Metaplanet on the Tokyo Stock Exchange just acquired 5,075 Bitcoin in Q1 for roughly $405.5 million.
So their average price was around $79,898.
Yeah. They now hold 40,177 BTC. That makes them the third largest public holder globally.
But the financial engineering is the crazy part. Metaplanet isn't using toxic debt.
No, they use a Bitcoin income generation strategy. They sell collateral secured put options to generate yield.
So basically, it's the difference between taking out a high-interest payday loan to buy a volatile asset versus buying an asset outright and renting out the basement to passively fund your next purchase.
That is a perfect analogy. Metaplanet has basically weaponized options premiums against fiat weakness.
Right.
In Q1 alone, this generated $18.6 million, which they instantly recycled into buying more spot Bitcoin.
Plus, they raised $255 million in equity, achieving a 2.8% BTC yield for the quarter.
They are completely insulated from the retail leverage wipeouts. And this brings us to the final major catalyst.
The 48-hour Clarity Act horizon.
Yes. Despite the geopolitical chaos and Western corporate capitulations, the entire regulatory architecture of the U.S. digital asset space is sitting on the edge of a binary resolution.
Right. Coinbase Chief Legal Officer Paul Grewal went on Fox Business and stated that a Senate compromise on the Digital Asset Market Clarity Act is very close.
He's expecting a resolution within a strict 48-hour window.
The bill has been stalled by this massive lobbying war over stablecoin yields, right?
Exactly. The new compromise will reportedly prohibit platforms from offering traditional passive yield on stablecoins, but it will permit narrowly defined activity-based rewards.
And it gives agencies 12 months to define those rules.
Right. But the institutional unlock is really Title IV of the Act. It gives the CFTC exclusive jurisdiction over digital commodity spot markets.
Which is huge.
Huge. And it mandates that futures commission merchants use qualified digital asset custodians. This requires cold and hot asset separation, multi-party computation, and SOC2 Type 2 audits.
The boring compliance plumbing.
Exactly, the plumbing. If this passes before the midterm elections, it instantly de-risks the asset class for multi-trillion-dollar conservative wealth management channel.
It provides the exact legal plumbing, pensions, and endowments actually required to enter the market. But I have to ask a pointed question here.
Go for it.
Given the fact that $173 million just fled the U.S. ETFs because of a spike in oil prices, will regulatory clarity actually be enough to bring conservative pension funds into an asset that currently trades like a high-beta tech stock during a global war?
That's the trillion-dollar question. In the immediate short term, macro forces and oil dominate. But in the long term, pensions simply cannot deploy capital without defined legal rails, no matter what the price is. The Clarity Act builds the tracks so the train can run once the storm passes.
That makes sense. So to summarize the core clinical takeaways for you today, the narrative of Bitcoin as an immediate geopolitical safe haven has been temporarily shattered. It's too highly correlated to the S&P 500 right now, and the reality of $112 oil is driving the bus.
Right. The market is violently purging over-leveraged retail traders and debt-burdened Western corporations.
While at the exact same time, sophisticated Asian treasuries aggressively accumulate using derivative yields. And meanwhile, the U.S. is racing against this 48-hour clock to pass the Clarity Act.
It's an incredibly volatile convergence of events.
It really is.
Yeah.
So I'll leave you with this final concept to mull over. If the NATO security alliance actively fractures, forcing European nations to print trillions for defense.
Which causes massive inflation.
Right. And if the United States simultaneously locks in a highly compliant qualified custodian framework via the Clarity Act, will the ultimate result be massive sovereign wealth funds quietly utilizing this newly created U.S. regulatory clarity to bypass traditional banking entirely?
And just accumulate directly on Asian omnibus platforms.
Exactly. It's a fascinating structural shift. Thank you so much for joining us on this deep dive.